Remember how Palantir was the talk of the town across Wall Street bets? Any online forum was talking about Palantir at the end of 2020 and beginning of 2021 because all you had to do was blindly buy call options and you made money. It was insane and everyone was in. There was a euphoric state around Palantir. Since that peak around $45, this thing has come down a lot. Currently around this $20 level, the question is it worth a buy? For those of you that aren't familiar with Palantir, it is a big data analytical company. They have clients, whether that's the government for counterterrorism. They also have commercial, so they're working with different enterprises or big companies, working through the data that they have and providing insights. So they have different platforms, whether it's Foundry, Gotham, Apollo, focusing on different things. But at the end of the day, this company is a big data company, and it's all about using that data to make decisions. A big portion of their revenue is from defense spending, and we know how lucrative that can be as the government loves to spend money when it comes to defense. They also have their commercial growth, which is also doing extremely well. Both the government side and commercial side are both growing at a good pace. The stock itself has only publicly been trading since October of last year. It direct listed around $10 and actually fell to closer to $9 before attaching rockets to itself, exploding the upside near the end of 2020. I actually remember being home for Thanksgiving last year and looking at Palantir and texting my buddy with everything that was going on and just the insanity of how much money people were making from this thing going up 20% every day with really no news. If you bought at the beginning of this year, it's a little different of a story, but I ended up getting sucked into the FOMO as well. Back in February, when growth stocks had a bit of a sell-off, I actually nibbled into Palantir. Granted, I only bought $165 worth, really nothing. As I was thinking about averaging into the position, I ended up not really adding to a full position because I thought there was a bit of a premium in the stock. I ended up later selling in August when it kind of rose back up, taking a $4 loss. Not really anything, but I was definitely interested in the company because of how exciting their future and the innovation of the company was. I mean, if you look at the macro environment for data analytics, it's expected to grow at a very high pace. We covered data analytics a little bit when I talked about Alteryx a little while ago. But this company with Palantir, they are growing much faster. Also, I love the fact that they give long-term guidance with 30% growth for the revenue through 2024. That's unheard of to see a company have this long-term guidance because it makes it a little easier to project out earnings as well as valuations. 30% revenue growth is nothing to sneeze at, so I understand the positivity around this stock. Let's take a look at the financials and a bit of the valuation to understand why has it been underperforming this year and can it turn around? We covered how this company is growing their revenues at an impressive pace. Are they turning those revenues into profits? And it seems like based on the accounting, they are still turning a loss. But when you look at their adjusted numbers, they're showing that they have positive earnings. Looking into it, it really comes down to stock-based compensation. This is kind of the red flag that I noticed with this company. And when I did my research, other articles and other people analyzing this company also brought this up. If you look at the number of shares that are coming online based off this stock-based compensation from a quarter-to-quarter basis, it's growing around 3.6 to 4% based on the past couple quarters. And if you compound that annually, that's a 15% growth in the share count, which there is a reason that the company is using stock-based compensation. When it comes to these tech companies, they're all fighting for the same talent pool. So in order to attract that talent and retain them, they have to offer something like stock-based compensation in order to entice those people to come and actually stay working at the company. Unfortunately, not everyone is smart enough in order to work at Palantir or Facebook or any of these big tech companies. The pool is pretty small, so I totally get it. Plus, the company can say, well, this isn't a cash expense. When you back that out, we're generating free cash flow as well as backing it out for EBITDA margins. We're doing pretty well. But that's a bit of a cop-out because I think the problem here is it's still an expense. So from an accounting standpoint, they're losing money, but they're adjusting it out in this adjusted EBITDA or adjusted earnings. And they're kind of hiding the fact that it's diluting shareholders in a way where the company can grow and be super successful. But at the same time, if you're a shareholder, you can actually lose money or the price increase in your shares won't be as significant. Don't get me wrong, stock-based compensation is something that has been going on with other tech companies. And so as long as the growth of the company is outpacing the dilution, then it's not the end of the world. Because if you do retain those people, focus on the employees that are generating that revenue growth, it's a win-win for both the shareholders as well as the employees who are getting paid a higher compensation package. As an investor, I'd rather the company pay higher salaries, show that accounting loss, and just own it that they're not profitable, and then go ahead and scale the revenue, keep the costs relatively fixed, and get to profitability. I'd rather see that than stock-based compensation getting out of control. Overall, I mean, the financials seem to be fine. They do have a decent cash position, so I'm not so sure why they're concerned with generating this free cash flow. When it comes to outlook and guidance, the numbers seem great. Q4, 40% growth in revenue, and they still reiterated that 30% increase in revenue per year through 2024, which would get them around that $4 billion figure by that time. Time to discuss what people really want to talk about is the valuation, in my opinion, on whether or not it's overvalued, undervalued, and my thoughts on the future. Currently, the stock is trading at a price to sales ratio of 28. I'm using a price to sales ratio for this company because they aren't profitable, and it's much easier to use something like the revenue as they've given an outlook on that number. With a 28 price to sales ratio, it seems kind of high, but in 2020 and 2021, a lot of these high growth companies have higher multiples. If you compare similar companies with similar growth rates as well as gross margins, Palantir is actually on the lower end. Is that good? It's hard to tell, because if all of these companies have contractions in their multiples, then they can all come down. I tend to be a little bit more conservative when I'm investing in these growth companies, especially after 2020, because their multiples did expand quite a bit. Usually what I do is I look at the 5-year growth rate expected for revenue and use a multiplier of like 20 to 40% to get a range of what I'd be okay with the price to sales ratio, which comes out to be 12. That would mean that the company is way overvalued. But if we use something like a benchmark from Finbox that compares similar companies to Palantir, you get something like a price to sales ratio of 20. Let's go ahead and use a more conservative number around 20. This is a little bit more subjective. If you think they deserve that higher price to sales ratio, then you could argue that the company is trading at a fair value based on the comparison to their peers. Whereas if you look at something like a benchmark and kind of historical numbers for these growth companies, then you could say that the multiple is a little high, and you could use something a little bit more conservative like 20. If you end up using that 20 multiplier, you come up with something around $14.60, which if you're a shareholder of Palantir, obviously you're upset with that, but that is a more conservative estimate when it comes to the valuation. If you're one to believe that the price to sales ratio at its current state is fine and that it's at fair value, then growing at 30% on an annual basis would obviously provide upside versus a normal return in the S&P 500. One thing to consider though is as you go out further in time, in 2024, will it still have a multiple of around 30 based on the next 5 years of growth? Will it continue to be able to grow at this 30% pace, or will it slow down? If there is a slowdown in that growth, then at the time in 2024, its multiple will be lower. Therefore, you may not actually be getting that 30% growth every year if that multiple contracts. When it comes to risks and ops, if you couldn't tell, I really didn't love the stock-based compensation. You're talking about a 15% dilution through end of 2024. The share count could potentially grow to 3.1 billion shares. If it was trading at a price to sales ratio of 25 and hit those numbers of their outlook of 4 billion, that's a $100 billion valuation, which is great compared to today, which is around 42. But with that dilution, that would put the price at around $32, which would be an annualized return of 15%, which is still better than historical average. I just think you're taking on a lot of risk to not get that much higher of a return versus something like the S&P 500. Of course, that's a bit of speculation because I don't know if the rate of the new shares will continue at its current pace, and it could actually decelerate or completely go away, which would change the price per share in 2024. You're talking about a $51 share price and 34% annualized return if they didn't dilute anymore, which obviously would be better for investors. Clearly, stock-based compensation is one of the things for me that kind of stops me from investing in the company. The second risk would be concentration risk. So they do have growing amount of clients, but a lot of the revenue is concentrated in the government. If contracts go away, they could lose a big portion of the revenue. Honestly, I don't see the government reducing their spending. So that one is a risk, but I don't see it as big as the stock-based compensation. Opportunities and the special sauce that may just completely destroy my entire thesis against not investing in the company is innovation and the ability ability to have a talent pool that is so smart, they are able to actually dominate the data analytics space. They're able to grow faster than the expectations that are already built into the company and able to outperform just based on pure engineering and innovation, something similar to Tesla. So for all the things that I talked about, I'm not going to be touching Palantir unless it comes down to a multiple closer to 20 or the stock-based compensation really decelerates to a more reasonable level or just stops altogether. Those, of course, are my opinions. I tend to be a little bit more conservative when it comes to projecting out growth. If the growth beats those expectations that are built in right now, then the stock could do well. If you did enjoy the video and learned a thing or two, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we talk stocks, investing, anything to do with money. Thanks guys for watching, and have a great day.